In the realm of electric vehicles, Tesla was the benchmark. However, its supremacy is now being questioned. In China, the colossal market for electric vehicles, Tesla is encountering challenges. Local manufacturers are gaining ground, benefiting from fierce competition and relentless price wars. To remain relevant, Tesla had to reduce its prices by 20 to 30%. Without this adjustment, its sales could have declined in the previous year. One competitor, in particular, has been challenging Tesla, BYD, backed by Warren Buffett. In 2023, this Chinese brand achieved 2,400,000 new insurance registrations, leading the Chinese market with an 11% share. BYD's rise is unprecedented, showcasing remarkable growth in a brief period. No automotive company has ever experienced such rapid expansion. The rise of BYD. Looking at the monthly rankings, it's evident that they consistently occupy top positions. In the year 2023, BYD manufactured over 3 million new energy vehicles, including plug-in hybrids and purely battery electric vehicles. This figure surpassed Tesla's production, which amounted to 1,840,000 vehicles. The gap between BYD and Tesla in the Chinese market is vast, almost to the point of disbelief. Initially, Elon Musk even scoffed at BYD. Previously, Chinese vehicle manufacturers were not considered serious competitors by other automakers. Foreign brands dominated the market in China, but today, the scenario has completely shifted in favor of Chinese brands. The vehicles produced by these Chinese manufacturers are of high quality. They are not only leaders in the Chinese market but also have ambitious plans for global expansion. In 2023, BYD's exports surged by 334%, reaching 242,765 vehicles across 70 countries. BYD holds about 40% of the electric vehicle market in China and is just beginning to explore international markets such as Australia, Japan, Europe, and possibly soon, the United States. According to CLSA, by 2026, BYD will be among the world's top 5 automobile manufacturers, with a chance of entering the top 10 this year. Originally a battery company, founded in 1995 by Wang Chuanfu in Shenzhen, China, BYD, whose name stands for Build Your Dreams, started as a manufacturer of batteries for cell phones, securing major clients like Motorola and Nokia, thanks to its low cost. After establishing its name in the battery supply sector, it ventured into the automotive industry. It purchased Xi'an Sichuan Automobile Company, and in 2005, launched the F3, its first combustion engine car. In 2008, it introduced the F3DM, a plug-in hybrid vehicle. BYD's initial cars, like the F3 and the F1, were simple and powered by Mitsubishi engines, a curious choice given their names reminiscent of Formula One. In 2010, it unveiled the E6, its first fully electric vehicle. While this represented progress, perfection was still far off. Taxis adopted the electric vehicle, attracted by incentives, but individual consumer interest was minimal. During the 2010s, BYD's automotive division grew, but slowly and with modest profits. Automotive advancement, a turnaround. Indeed, in 2018 and 2019, BYD saw its annual sales decline. Until recently, it was questioned whether it could establish itself in the automotive sector. However, it reversed this trend. In 2019, I observed some of its new vehicles, called Tang and Han, designed by renowned German designers. At first glance, you think, these cars are well designed. They showed potential. In 2022, the company ceased the production of its internal combustion engine cars, focusing on battery electric and plug-in hybrid vehicles. Its automobiles are mostly aimed at the mass market, which aids in sales volume. Moreover, the transition to fully electric vehicles was not made abruptly. BYD has the backing of Warren Buffett's Berkshire Hathaway and considered entering the North American market in 2008, when Buffett acquired 10% of the company. Warren Buffett stated, "My bet is on the person." He admitted not understanding technology or being sure about the Chinese market or whether electric vehicles would take off. But he saw something special in Wang Chuanfu and decided to invest about $250 million. A major motivation for the investment was the battery segment, more than the vehicles themselves. This sector, along with car sales, has grown exponentially. Since Buffett's initial investment, BYD's shares have appreciated more than 1,400%. Berkshire Hathaway has reduced its stake in the company, selling over 60% of its shares since last summer. Geopolitical concerns, such as the situation with Taiwan, were cited as reasons for the sale. Another reason is the price war initiated by Tesla at the end of 2022, which has been intense. So much so that most electric vehicle manufacturers in China are currently operating at a loss. Only Tesla, BYD, and a few others are profitable. BYD's pricing strategy is crucial to its success. They offer vehicles at lower prices than their competitors. In Munich, a few months ago, they launched the Seagull for, believe it or not, $11,500. A very competitive price. BYD's expertise in batteries, generally the most expensive component of an electric vehicle, also contributes to this strategy. The company designs, develops, and manufactures its own batteries on a large scale. This not only equips their products but also allows them to supply batteries globally, with plans to build factories worldwide. They are world leaders in the manufacture of lithium iron phosphate batteries, which are about 30 to 40% cheaper per kilowatt-hour and extremely durable. As pioneers in battery technology, they supply other manufacturers like Tesla, Toyota, and Kia. In 2020, they launched the Blade, an innovative battery that stood out for its high energy density and safety. According to experts, the Blade is currently the best in its class globally, maximizing energy density in a way that attracts the industry. BYD's global expansion. BYD's venture is not confined to daily use automobiles. The manufacturer produces an array of vehicles, including trucks and buses. In the United States, the company assembles and sells electric buses in a facility located in Lancaster, California. Commercial fleet vehicles, such as buses, constitute a significant segment of its business, covering markets in the US and Latin America. However, it's their passenger cars that dominate the company's sales. Offering a wide range of models, BYD caters to various price segments. Among the series offered, the Dynasty lineup stands out, featuring models from the Qin, starting at approximately $14,000, to the high-end Tang, with prices beginning around $34,000. The introduction of the Han sedan in July 2020 marked a turning point for BYD, positioning it prominently in the renewable energy segment. The Ocean series, aimed at a younger audience, includes the Seagull, the brand's smallest vehicle starting at about $10,000, and the Seal sedan, starting in the $22,000 range. The launch of the Dolphin and Seal models came with a variety of color options, targeting young families and women in particular. BYD has also expanded its product line through luxury sub-brands such as Denza, Yangwang, and Fangcheng Bao. Denza, a partnership with Mercedes-Benz established in 2010, initially focused on the Chinese market, undergoing a restructuring in 2021. Despite Mercedes reducing its stake to 10%, BYD continued to develop new models, such as the D9, a luxury minivan. Yangwang, introduced in 2023, targets the luxury segment with models like the U9 supercar and the U8 luxury SUV, also announcing the U7, with 4 electric motors and a range of about 500 miles. Fangcheng Bao, also established in 2023, unveiled its first vehicle, the Bao 5, in November of the previous year. Yangwang is clearly BYD's attempt to capture the high-end luxury segment, with vehicles that are either immense or fall into the sports car category, distinguishing itself from the rest of the company's lineup. Automakers often seek to create flagship vehicles that elevate the brand's image. BYD follows this trend, demonstrating confidence by stating it can compete with brands like Ferrari, Lamborghini, and Porsche. BYD, a leader in electric cars in China, aims to expand its presence to other markets. Around 2018 and 2019, facing a market slowdown and declining profit margins, Chinese manufacturers recognized the need to explore international markets to avoid saturation and intense domestic competition. The company is already a strong name in Southeast Asia, holding 43% of the electric vehicle market and leading sales in Thailand, Brazil, Colombia, and Israel. In Thailand, the brand went from almost no presence to becoming the top seller in a short time, with plans to double sales in the Philippines and Singapore. It recently started operations in Mexico and plans to enter the Japanese market, launching the Dolphin model in Mexico and expanding its presence in South America, where Tesla still has limited presence. BYD's presence in Europe is growing. Last year, the company sold 13,000 vehicles on the continent and acquired a cargo ship capable of transporting 7,000 vehicles, facilitating cost control and reinforcing its vertical integration strategy. BYD's priority abroad is Europe, due to favorable policies for electric vehicles, the availability of buyers, and the charging infrastructure. The company announced plans to open its first factory in Hungary, though it faces challenges related to European Union investigations into subsidies for electric vehicles made in China. China's automotive rise. In China, electric cars have received substantial government support. The Rhodium Group estimates that BYD received approximately $4.3 billion in state aid from 2015 to 2020. However, the big question remains, will BYD attempt to market its vehicles in the United States? They are organizing to enter the American market, just waiting for the perfect opportunity. The US and European markets represent a significant profit opportunity. It's crucial for them to penetrate, compete, and succeed in these locations to stand out globally. Currently, tariffs raise costs, with Chinese electric vehicles facing a 25% tax, in addition to the 2.5% tax on imported cars. Several of these companies, along with their investors, which, in some cases, include various levels of the Chinese government, show greater tolerance, at least for now, to absorb losses in order to expand their market share. It was recently announced that a factory will be built in Mexico, possibly aiming to establish a presence in the North American market. Few people are aware, but China is already the largest supplier of automobiles to Mexico. The next logical step is setting up manufacturing plants in Mexico. They are advancing in site research and plan to ship their vehicles to the United States, starting, as they expect, after 2025. What are the chances of the Chinese getting even closer to our market? In the next 5 to 6 years, we'll likely see several automakers starting final assembly in Mexico. Many say Americans won't buy Chinese products. But, if asked whether they prefer to pay $9,000 for an SUV or $19,000 to $20,000 for one, the choice is obvious. And this reflects the thinking of everyone we've spoken to here. American lawmakers have warned that Chinese manufacturers could saturate the market, threatening local producers. Authorities in Washington, D.C. are definitely aware of this, and you can be sure they're in touch with Mexican representatives. The danger to the United States is real, especially at a time when the UAW has just negotiated record-high wages and benefits. In Australia, Chinese manufacturers face no tariff restrictions, and BYD has expanded significantly. Since its entry into the country in 2022, it has captured 14% of the electric vehicle market. Tesla leads with 53% but has been there since 2014. Chinese automakers are among the most competitive in the world. I believe they will achieve significant success outside China, depending on tariffs or trade barriers imposed. Frankly, without trade barriers, they could surpass most global competitors. Their excellence is undeniable. However, with China emerging as an automotive superpower, containing its ambitions may be challenging. Chinese manufacturers have quickly learned to produce attractive vehicles. They are more affordable and, in many respects, superior. The rest of the industry has reason to worry. Currently, China has the capacity to meet half of the global demand for automobiles. Considering its strength, low cost, innovative designs, and improved quality, the question arises, what will stop this giant? Would you know? We'd like to hear your opinion, so please write to us below in the comments.